If you are a trader, you've probably watched at least one of TJR's videos. He's one of the most watched smart money traders on YouTube right now. But have you ever wondered if his strategy actually makes money? Well, me too. So, I did the unhealthy thing and watched 293 of his videos. 136 hours, 20 minutes, and 35 seconds. Then I turned everything into over 10,000 lines of code to answer a simple question. Does his strategy actually work? Before we test it, we need to understand why this setup became so popular, because on a finished chart, it looks almost perfect. Price is in an uptrend. When it breaks the previous high, new traders jump in with buy orders. Big institutions need massive volume to fill their positions, so they use all these new buy orders as fuel to open their shorts, driving the price down. The breakout fails, and a few candles later, price breaks structure in the opposite direction. The story is clear. Big institutions trapped buyers, swept liquidity, and the trend reversed. Then price pulls back into a fair value gap, an order block, or an equilibrium zone. And that becomes the entry. The exact same logic works in reverse during a downtrend. Liquidity sweep, break of structure, retracement, and boom. It looks logical. It looks repeatable. But there is a huge difference between a story that seems to make sense and a strategy being profitable. So I watched the videos from one of the most watched smart money traders, TJR. But the more I watched his videos, the more I realized something I didn't expect. The rules don't fit together.
Lack of buy orders. So what is price going to want to do to this imbalanced price action? It's going to want to balance it back out, fill in that imbalanced price action, fill more sell orders so price can what? Move further to the downside. Plain and simple.
Liquidity, fair value gap within here, liquidity. Everything gets hit.
Time to put your trader's cap on for a second. Did you catch the inconsistency? In one video, he explains that a fair value gap is a zone the market respects and doesn't break very easily. In another video, he places a take profit on the far side of a fair value gap as if price will easily move straight through it. And of course it does, since the trade is taken in hindsight. This wasn't the only contradiction. There were others, and this is a common hidden safety net of discretionary trading. If you win, you apply the strategy correctly. If you lose, you applied the wrong version. Either way, the strategy is never wrong. Only the trader is. Contradictions weren't the only problem. Some of his rules aren't really rules at all. They're assumptions. For example, here TJR marks all the swing points on the chart. But why didn't he pick this swing high? Or this one? Or this swing low? They look just as valid. How do I decide how many candles to look left and right before something counts as a swing high? 6 candles back, 2 forward, 8 and 4, 12 and 6. Each choice changes the trades. Here's what that looks like in practice. With 6 candles back and 2 forward, this is a swing high, the highest point in its range. Change the definition to 12 and 4, and the same candle is no longer a swing high. So if we choose tight parameters like 2 and 1, we catch every wiggle and flood the chart with noise. If we choose loose parameters like 20 and 10, we only mark the major turns, but miss real setups in between. And that was only one of the concepts to code. Every other piece of the strategy needed the same treatment. And little did I know, it would take me more than 10,000 lines of code to replicate every single nuance of TJR's trading strategy. But when I was done, the strategy wasn't a few rules on a chart anymore. It was a system that replicated TJR's trading framework exactly the way he teaches it. Throughout his boot camps, TJR makes one thing clear. A liquidity sweep followed by a break of structure is already a complete valid signal. You don't have to wait for anything else. So that's where I started. Version 1, the simplest version of the strategy. Sweep, break, enter. Stop loss goes just beyond the wick of the liquidity sweep. Take profit is split into 3 parts. Each part is placed at a previous important level of the market, but with a minimum risk to reward ratio of 1:1 for TP1, 1:2 for TP2, and 1:3 for TP3. Price hits take profit 1. A third of the position closes and the stop loss slides to break even. From that point on, you are trading risk-free. The trade can't lose money. Take profit 2 hit, another third out. Take profit 3 hit, the trade closes. Then I set risk per trade at 1% of equity, and only 1 trade per pair can be open at a time. Also, to prevent taking trades when the market is barely moving, I built session and volatility filters to skip the quiet hours in dead markets. I tested this on 4 currency pairs: Euro dollar, pound dollar, dollar Japanese yen, and pound Japanese yen. 3 time frames: 5 minute, 15 minute, and 1 hour, from January 2016 to May 2026. 12 markets, more than 10 years. 2 final details before the results for version 1. Remember the headache from earlier about swing points? I solved it by testing several reasonable values and used the one that gave the strategy its best overall results. Yes, this is technically called in-sample optimization, a form of overfitting. I gave the strategy the most favorable version of itself on purpose. If it doesn't work even with that advantage, then the answer is simply that the strategy doesn't work. And I also removed all transaction costs. No spreads, no commissions, no slippage. The results you're about to see are not pessimistic. They are the best case. So with everything set, I ran the tests for version 1. Python is great for running the analysis, but the raw output is quite ugly. So I rebuilt the results into a table. The average return across all 12 combinations was 20.13% over 10 years. So the strategy was profitable. But 20% over 10 years isn't great when the S&P 500 returned 306% in the same period. And even our best performer, pound dollar on the 15-minute time frame, returned only 115.7% over the decade. Slightly more than a third of what the index returned by doing nothing. Honestly, we don't even need to bring the S&P into this. 20% over 10 years is about 1.8% per year, which in some countries is less than what your savings account pays you. But V1 starts to give us some clues to work with. First of all, the 15-minute time frame looks like the sweet spot. Less noise than the 5-minute, but still enough setups to generate opportunities. In our first test, it clearly outperformed the other time frames. Also, the strategy seemed to prefer pairs with stronger directional movement, while euro-dollar was the clear weak spot. Another interesting thing to notice is the hit rate of the take profits. Take profit 3 was hit, only 17.6% of the time. So while it is true that take profit 3 gives you a very good risk to reward ratio, it is also true that the win rate using take profit 3 drops drastically. And this is something I want to spend some time on because I think you can significantly improve your trading results by understanding this concept. Splitting a trade into several take profits and moving the stop to break even after take profit 1 is the structure TJR teaches, and that hundreds of YouTubers endorse. It sounds smart until you backtest it. And most of them never backtest it. So here is David doing the work for you. But who am I to tell you any of this? I'm David. I'm not going to show you my face, and honestly, that's the point. In this game, your face doesn't fill a single account. The tape does. So let me show you the tape instead. I've been trading order flow on the S&P 500 futures for years, reading absorption, the New York Open, where the real money is actually getting filled, not indicators, not predictions, just what the market is doing live. Back in 2020, I co-founded a trading academy with my partner, Antonia. 5 years later, we've trained 5,000 plus students. Our people have been funded over $6.5 million in prop capital. And I've personally managed north of $2 million on my own funded account over the last 14 months. 286 trades plus 37.75%, profit factor 1.23, worst month included. I don't hide the red. I audit it. I'm telling you this not to impress you, but so you understand I'm not a guru with a course. I'm a trader who happens to have spent 5 years figuring out why 90% of people who know what to do still can't execute it. And I built a semi-automatic model to close that gap. That's who's talking to you right now. This is a risk to reward calculator I built, so we can follow the math behind this concept in a simple way. Imagine a trade where you risk 1R. You place your first take profit at plus 1R, your second take profit at plus 2R, and your third take profit at plus 3R. You may think you have divided your trade cleanly into a 1-to-1, 1-to-2, and 1-to-3 risk to reward ratio. Wrong. When TP1 hits, you only close a third of the position. So you walk away with 0.33R. But when the stop loss hits, you lose the full position. That's minus 1R. If TP2 also hits, you might think you've added another 2R. But again, you only closed a third of the position. So you actually added 0.67R. Combined with the 0.33R from TP1, that's a total of 1R on the trade. All this work, 2 take profits hit, and you've made the same amount you would lose from just 1 stop loss. Finally, if all 3 take profits hit, the trade closes at plus 2R total. Just double the risk. That's the absolute best case. And remember, only 17.6% of trades got there in our first test. This is one of the painful realities of partial scaling. It reduces emotional pressure. It makes the trade feel safer. But unless enough trades reach the final target, it can quietly damage the payoff structure. Even if you increase TP3 to 10R, for example, trying to hit the jackpot, your entire trade will close with a risk-to-reward ratio of 1 to 4.34. Yeah, 4.34R sounds good, but remember that your trade has to travel 10 times the distance of your stop loss to capture that reward. Realistically, you are not going to hit that take profit very often, while every loss will still eat an entire 1 hour. This tells us that already a better version of this strategy could be achieved by revisiting the take profit structure. But for now, I just want to present the results of the original strategy. We will have time to discuss what I did to improve the results and how you can apply the same concepts and findings to your own trading. Overall, version 1 is not worthless. It found some positive areas to work on, but as a broad strategy, the performance is weak. But let's not get discouraged because we still have not added some pieces that form the complete strategy TJR uses. The next step I took was to add the daily and weekly bias. The rule TJR teaches is simple. Don't take a trade unless the daily and weekly charts are aligned with the direction you want to trade. So for long positions, both daily and weekly must be in an uptrend. For short positions, both must be in a downtrend. If they disagree, we skip the trade. So I built the filter, optimized the swing point parameters for this new version, ran the test, and compared the results to V1. Well, adding the daily and weekly bias filter made the strategy noticeably worse. The average return dropped from 20.13% to 7.85%. 9 of the 12 combinations got worse. Only 3 improved, although pound Japanese yen had a significant boost. Overall, higher time frame bias made the strategy worse, not better. This is a key finding, and once you look at why, it actually makes sense. Quick question for you. What would you say about this chart? Uptrend, downtrend, or neutral? I'd say downtrend, and I'd guess most of you would say the same. Now, what about this one? Strong uptrend, right? Both of these are Euro Australian dollar. The chart on the left is the weekly, the chart on the right is the 5-minute. And here's the thing. Everything you see in that 5-minute chart happened inside just 2 candles on the weekly. For 2 entire weeks, the bias filter would have told you to look only for short trades. And not only would most of those short trades have lost money, you would have missed every long opportunity that actually worked and made money. The lesson isn't necessarily that higher time frame bias is useless. The lesson is that time frame distance matters. A weekly chart and a 5-minute chart are just too far apart. And if your filter is too far away from your execution time frame, it may not improve your trades. So, V1 isn't helped by adding higher time frame bias. But there's still one major piece of the strategy we haven't tested, the retracement entry. The part where TJR tells you to wait for price to pull back into a fair value gap, an order block, or an equilibrium zone before entering. That's version 2, and that's what we're going to test next. So, in version 2, the first part of the strategy is the same. We wait for a liquidity sweep, then a break of structure, but instead of entering right away, we wait for price to retrace into a fair value gap or an order block. In equilibrium acts as a filter. We only take trades retracing past the 50% mark, where price is in a discount for long positions or a premium for short positions. The expectation was simple, better entries, better results. But that is not what happened. V2 gave an average return of 4.23% over 10 years. Only 6 out of 12 combinations were profitable. Version 2 performed substantially worse than the simple sweep and break we tested in version 1. If we check results by time frames, once again, the 15-minute time frame outperformed the others. If we check results by currency pair, we find that Eurodollar was yet again the weak asset. Another very interesting observation concerns the entry type. TJR teaches that the more confluence on an entry, the better the trade. But the data shows the opposite. Order block trades carried the entire V2 strategy. They generated 142 R of profit across the test. Fair value gap trades lost 40 R. And the trades with both signals together, what TJR calls high confluence setups, lost even more, around 45 R. The setups that are supposed to be the strongest are actually the weakest. Finally, take profit 3 was hit 16.7% of the time. This reinforces a key finding we discussed earlier, which strongly suggests that we can significantly improve results by applying a different take profit structure. So V2 is a disappointment, but it's informative. We start to find patterns that repeat across all versions. And these patterns are the real takeaway. They give us specific directions to make the strategy profitable and immediately improve our trading results. We only needed one final version to test, V2 plus the daily and weekly bias. This is the complete TJR framework. Liquidity sweep plus break of structure for the first impulse. Wait for a retracement to a significant level with equilibrium working as a filter. Then only take the trade if the trend on the daily and weekly chart is aligned with your trade. The final test. So, let's run it. The complete version of TJR strategy, the one including all the core concepts he teaches, shows very negative results. Once again, the 15-minute time frame is the clear winner, and euro-dollar is the worst currency pair. But the average return is minus 5.22%, and only 3 combinations out of 12 end up in profit. And let's not forget we are testing optimized swing parameters and no transaction costs. In real trading with spreads, commissions, and slippage, these results would almost certainly be worse. So, the data is clear about one thing. If you had traded this strategy over the past 10 years, you would have lost money and a lot of time. But this project was not worthless. Actually, it revealed something very important. The more we added to the strategy, the worse the results got. V1 averaged 20.13%. V1 with bias dropped to 7.85%. V2 dropped again to 4.23%, and V2 with bias finished at minus 5.22%. That is the opposite of what you've been taught. More filters did not create better trades. It made the strategy weaker. We opened this video with one simple question. Does TJR's strategy actually work? After 2 months of research, coding, testing, and interpreting the results, my answer is no. As a broad strategy, the performance is weak, especially relative to the amount of screen time and psychological stress required. But I want to be clear that this is not a personal attack on TJR. My goal here is to show you a strategy that actually works and to help you become a better trader. TJR may trade with experience and discretion that are difficult to capture perfectly in code. That is possible. But that is also exactly the point. If a strategy only works when the trader can constantly reinterpret the rules, then the edge is not in the strategy itself. So my conclusion is not TJR cannot trade. I don't know and I'm not interested. My conclusion is the strategy, as taught publicly, did not work as a broad system. But I don't think the whole strategy is useless, because inside the failure, we did find some interesting clues to work with. And so I started from there. I built a random forest model to identify what actually drives the strategy's profitability and what's just noise dragging it down. I rebuilt the take-profit structure based on what we found in the math earlier, and I expanded the asset base to include more directional markets like gold, Bitcoin, and stock indices. Did it finally work? Did we find a smart money strategy that actually beats the market? One you can use in your own trading. The answer in the next video.